Today on InvestTalk, we look at 5 financial year-end to-dos, then I discuss the market sell-off to close the week, then I answer questions about DraftKings, ZBRA Technologies, Mueller Industries, and more, and at the end I cover the future path of Fed policy.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today has to do with year-end planning. We only have, we have 6 more weeks left in the year, 6-7 weeks, and there are always some deadlines that are December 31st, and that means that you're up against the clock in some respects. And we'll look at 5 of the most important aspects to check off as we head into year end. Now, the first would be simply rebalancing. You know, we've had a good year for equities overall. And I think as we head into next year, there's, I think, a bit more uncertainty. You know, we had certainty around the election, but, you know, we have an administration that is, whether you like it or not, you know, thinks a bit differently. And, you know, that different can turn good. But as you know, different can turn out bad as well. You know, so I think there's just a bit more volatility to the potential outcomes of the overall economy, as well as different sectors, right? So rebalancing your portfolio away from assets that have, or asset classes that have done fairly well, and put them more into areas that you're underweight. Okay. So chances are you might be overweight large cap growth stocks. And for retirees, this might be an opportunity to take some of those chips off the table and move them into fixed income and cash for near-term needs, okay, for the next 12, 18 months or so, okay? Now, if you're a younger investor, it might not be reducing your overall equity exposure. It could just be rebalancing it into other parts of the market, right? Reselling some of the large cap growth into more value side of the market, or maybe even smaller companies, et cetera, especially now that small caps are starting to outperform. Okay, so that's job number 1 as we head into year end, and try to get those portfolio weightings in line. Then number 2 would be RMDs, and this is, you can kind of use this as an opportunity to do both, right? So if you have IRAs, you can trim some of those positions within your IRAs that, you know, there are no tax consequences there, but you're going to take money out of your RMD anyway. That will be a tax consequence, but this is freeing up cash for those RMDs. Okay. And then number 3 would be your company retirement plan. You have by December 31st to hit those limits. So if you're under the age of 50, the most you can put in is $23,000. If you're over the age of 50, it's $30,500. Okay. So look at how much you've contributed. Maybe see if these last couple of paychecks for the year, you could up your deferral and try to max those out as much as possible. And talk to your HR department and do that for the short term, and then return it to a normal level once we get into January. But obviously, it takes time to do that. You might only have 2-3 payments or paychecks left, and so see if you can afford it, max out those workplace retirement accounts. And then insurance coverage. You have open enrollments, probably for your healthcare plan at work, as well as Medicare. Open enrollment happens until December 7th. So make sure you look at that. Opportunity to choose new Medicare Advantage plans, opt into original Medicare or vice versa. So revisiting those plans, and then your whole insurance coverage, not just health insurance, but you have disability insurance, see what needs to be covered, right? You might have put that disability insurance in place 5-10 years ago, and it may not live up to the amount of money that you're making now or your needs if you do get disabled, right? Same thing with revisiting your property and casualty insurance, shopping around, making sure those are the right amounts. And then lastly, charitable deductions. You have to do that by December 31st as well. You could take advantage of something called qualified charitable distribution from your IRA. Okay. So instead of taking the hit on those distributions, you could put those into those QCDs, as well as donor advised funds. This is a good way for you to donate a highly appreciated assets, not taking the tax hit on them, but instead donating those directly to either directly to a charity or through a donor advised fund, where you still control. We can manage donor advised funds for anyone out there if you ever have any questions on that. But donor advised funds will allow you to manage the portfolio, invest the assets, and give to a charity at a later date, but take that deduction today. So that's something to consider as well. Enhance your investment knowledge. Subscribe to the KPP Premium Newsletter for access to exclusive content and expert advice. Let's take a quick look at the markets for today as we close the week, and it was decidedly negative overall. And if you look at the S&P, that was down 1.3% on the day. You had the NASDAQ down 2.25%. That's really where the weakness was concentrated across the markets. And I think that is, let me pull this up here. There we go. Yeah, you had Amazon down 4% on the day, AMD down nearly 3%, Broadcom down over 3%, AbbVie, that was down 2.75%. So healthcare certainly continued its weakness, and Adobe down over 5% on the day. Applied Materials, this is on the back of the ASML earnings a couple weeks ago, and there was some poor guidance there. And AMAT, Applied Materials, is another chip equipment manufacturer, and that was kind of the double whammy within the chip space, and the chips overall were weak. NVIDIA was down 3.25% on the day. Microsoft down nearly 3%. Meta down 4%. Tesla was the one higher after the sell-off yesterday, so that was up 3% on the day. But definitely some broad-based weakness, especially for the smaller caps. You had large caps. Small caps are down about 1.5% on the day. And certainly the weakness was concentrated on the growth side of the market. You had value, large cap value was only down 0.3% of the day, whereas large cap growth is down over 2%. So, one thing to understand, this is OpEx, okay? Something that is greatly underappreciated about near-term market moves has to do with something we call market structure and option dealers. Option market has gotten so big that dealer activity is very important. And when I say that when dealers are selling options, they also hedge their position by buying the underlying stock. It's called the gamma hedge. And so as you get closer to an options X period, oftentimes you get those dealers unwinding their hedges, meaning unwinding the long positions in the market. And so you get sell-offs around typically going into the last couple of days of OpEx, like the last that you've seen today and yesterday, as well as the following week as well. And so I could easily see, this correction or this pullback from the Trump bump continuing into next week. And that's something, in addition to the gamma hedging part, there was a lot of risk involved, risk priced into the election, that there would be some sort of contentious election, that it would not provide a clear winner, and there would be political violence, et cetera. Obviously, that didn't happen, and that was overblown. But what happens when that volatility comes out of the market and it's compressed, asset prices tend to rise because they become less risky. And so that is another aspect of the Trump bump. A lot of the market went up because of Trump was elected. Sure, certain, I think, sectors moved and parts of the market moved because of that. But in general, the market moved because there was an unwind of the lack of realization of that risk that was priced in. And so that's what you saw mainly. And so now you're getting to a more orderly market. You're kind of getting past that. And now the market's starting to starting to handicap, especially with a lot of the Trump appointments this week, what future policy will be. One good example is Lockheed Martin and the other defense contractors. Those are weak. I think that's on the back of the Tulsi Gabbard appointment to the head of intelligence. And clearly there's a potential for less hawkish Defense Department, Intelligence Department, et cetera. So, that's kind of what you're seeing underneath the surface, kind of those movements. But in general, a lot of what happens in the near term, like I said, is market structure based. But the media likes to throw a narrative behind it because it's more interesting. Okay.
Hi, InvestTalk. I had a question about DraftKings, tickers DKNG. I'd like you guys to take a look at this. I know it is expensive, but as a speculative play for a long-term hold, what price target do you think would be a good opportunity to take a position? I'll listen on the show, and thanks, guys.
So what I do with these names, I'll tell you how I kind of approach these growthier names that are approaching profitability. And that's really what's happening here with DraftKings. 3 of the last 4 quarters, they've made money, but they are supposed to still lose 72 cents a share this year. Okay, but then make $55 cents next year. But it's about a $40 stock, $39.84 at the close today. So you're talking about 80 times forward-looking earnings. Now they are growing their revenues by 30-40% year over year. And so if you continue with that, then it can turn into a really, really good business. And if you look at the multiples, it's trading at other types of multiples. Price to sales is at 4, high but not egregious. Okay, so that's a positive there. Free cash flow is now positive, but profitability metrics remain negative. If I look at the shares outstanding, those continue to go up, so more dilution of shareholders. So that worries me a bit. But how I handle these companies is really more about the technicals. If I believe in the name, if I believe that this growth will continue, then it's technicals and that follows through, right, with the actual performance of the business. Then the technicals generally are going to remain bullish throughout. And what I see with DraftKings is pretty much since the highs back in, when was this? March, April timeframe, when it was around $47 to $50 per share. Since then, it's gotten much weaker. The technicals are poor. You have earnings expectations are mixed for, once again, this year and next year, in their trajectory, higher for this year, but lower for next year. And next year is the most important one, right? What does that profitability look like? Does it actually get there? Does cash flow turn consistently positive? Right now it's 48 million, but that's kind of flattened out. Okay. And that's what worries me here. I think this growth is kind of flattening out. Why are they issuing more shares still? They have a good balance sheet. But for now, I don't have a number because the technicals are just neutral to poor. And so I would want a better technical setup for me to get into DraftKings. That's DKNG. Thanks for the call. Now let's pivot over to a question that came in via our YouTube channel comment section. Isaiah Tipton says, very curious what your thoughts on ZBRA Technologies, ZBRA. I've had around 13% of my portfolio, so I know I need to trim, but I really love the business. I think it's a lot of room to run. Could you evaluate this company, its future within the space? I love this question because this is actually on our watch list, a name that we would like to own. Now it has run. We do think there will be a pullback to buy this over the next 6 months or so, but we do like the business. Now, for everyone out there, what they do, it's about a $20 billion market cap. They make direct thermal and thermal transfer printers and RFID printer encoders and card printers. So this goes into these are basically RFID readers is their main business, and goes onto products and allows supply chains to move along efficiently and effectively. When you bring, and I think there's a lot of secular tailwinds here, bringing manufacturing back to the U.S., most importantly, is the data. The more that manufacturers can track movement of their products, quality of their products, et cetera, the more data that they can get around their supply chains and manufacturing capabilities, the more that they can improve upon them, especially with AI, right? You feed that data into AI and it can tell you some things about your business that maybe you didn't realize, that can squeeze out efficiencies and lower costs, et cetera. And so I think we really like the business overall. It has got a bit of a head itself in the near term, but we like it. So, it is showing a bit of weakness since the Trump bump. In fact, it's almost done a round trip from the election night. So I do think technically you could start to see a pullback in the near term, but I would continue to hold it. But yeah, 13% of your portfolio is too high, and I would use this opportunity to trim here. Okay.
Hey, Luke and Justin. This is Jake from California. I know you guys have been talking about tariffs after the election, and I was just calling to see what you guys think of investing in international funds. I'm currently in primarily India and Mexico funds, with FLIN being my India exposure and FLMX as my Mexico exposure. Each are roughly about 3% of my overall holding. But I'm just wondering what you guys think now that the election's over on these funds, and whether I should add as they've both pulled back, or if we kind of assume that they'll go further down. Appreciate your input and look forward to your answer on the show.
Well, I like the idea of both. I think both countries have good secular trends behind them, mainly demographics. Both have very young populations, and you compare that to most of the developed world and even many parts of the developing world. Think of China, right? China's demographics are terrible. Both Mexico and India have a lot of young people and sound populations. And now India is obviously in a more volatile part of the world, and that becomes a bit of an issue. And historically, they have, kind of corruption issues and infrastructure issues and things like that. Mexico has, some similar problems, but obviously being close to the U.S. is a big advantage for them. And being from a security standpoint, so far away from, the major problems in the world, that's helpful as well. So I like both. The issue near term is just the dollar, right? The dollar strength is naturally going to take the wind out of the sails of pretty much any foreign markets. So, these are always hard to time, because not only are you timing the economic growth and the quality of the businesses that are within these names, but you're also timing the currency fluctuations. So these are more like longer term allocations, and I have no problem with either. Like I said, I think both have good long term secular tailwinds. So I wouldn't be selling any of them but you have to stomach the volatility. Okay. And so these are pretty good exposures out of all the potential exposures that are out there in the foreign markets right now. Now, on Fridays, we generally make time to fit in a quick rundown of some key benchmark numbers. So let's do that right now. The 2-year yield, 4.3% at the close. That's up from 4.25% at the close last week. So you continue to see those 2-year yields march higher. And what that is telling you is that the Fed cutting cycle continues to be cut short, or is likely to be cut short. Okay, so that's what that march higher is telling you. The 10-year up to 4.43% on the close of the week, and that's up from 4.3, roughly 1%, 4.31 the close of last week. So that was up even more. You have the yield curve steepen. Obviously, the market is either calculating two things: stronger economic growth going forward, or the Fed and Treasury losing the long end of the yield curve. I think there's two ways of looking at this, and it's kind of up to interpretation at this point. Gold, $25.62 an ounce. That was down from $26.85 an ounce. Pretty big pullback there. Also, once again, the dollar, strong dollar, is certainly taking the winds out of the sail in the gold market. But overall, the technicals remain bullish for gold and precious metals overall. Silver, $30.32 per ounce. The close this week down from $31.24 the previous week. Same thing, just a pullback to the 100-day moving average on silver, still in a broader uptrend of higher highs and higher lows. Oil, $67.27 an ounce per barrel, and that's down from $70.38 last week. Obviously, there's maybe the market is pricing in more drilling, more supply coming on market, etc. And that was a weak week for oil. And the amount of gas, or the price of gas nationally, is up to $3.08, or shall I say, down 1 cent from last week, $3.08. Here in California, $4.47. That's down 4 cents week over week. For comparison, in North Carolina, gas is only $2.92 per gallon. And we definitely have some clients out there in North Carolina. Actually, a college friend of mine, Mike, hopefully you're listening, and he lives out there in North Carolina. So that was the rundown of the economic numbers for this week. Now let's touch on small caps. Small caps got the most Trump bump over the past week or so, and they've surged really since mid-October, outperforming mid and large caps over the last month. And one standard argument for why small caps typically fare better in a lower rate environment hasn't really held. Saying a lot of people said, if interest rates go up, small caps debt burdens are going to increase because, right, they tend to issue in the junk bond market. They're not locking in their rates for very long, and so they have to refinance at these higher rates. Well, the reality is small caps debt burdens actually fell over the past few years. So higher interest rates actually have not hurt them very much. In fact, what's happened with many of them is that their operating leverage has allowed them to have good cash flow and start to pay down their debt. And so that's been pretty prudent and great for them. So that's one interesting little shift, that narrative sometimes doesn't really jive with reality. So don't always follow just the narrative. Now, the market consensus so far is that President Trump will be a boost for growth, economic growth. And smaller companies tend to be more economically sensitive to those larger ones. A lot of times they have that operating leverage that I was talking about. And so a better economy means more to the bottom line of these companies. And then on the tax front, corporate taxes, they tend to help smaller companies more than big ones. Why is that? Number one is they tend to generate more of the revenue domestically. So if you have domestic tax cuts, it's going to impact more of their revenue, right? If you have businesses out of the country, a domestic tax cut isn't really going to help you because you're going to be taxed based on where that business is domiciled, right? Or where that business is happening in Europe or elsewhere. So that's number one. And number two is large and even mid-sized companies, they have a team of tax attorneys that are already streamlining their taxes and finding every write-off and finding every way to save a buck from the IRS. And so a broader tax cut isn't really going to help them because they're already taking advantage of most loopholes. Whereas smaller companies, they can't really afford that as much. And so those tax cuts really impact them more. And in fact, Goldman Sachs put out a report about what sectors and as well as which parts of the market are more sensitive to the tax rate. And the most sensitive was the Russell 2000, the small cap index. You know what's interesting? You know what's next to that? It was consumer discretionary companies, and then communication services, then financials, then industrials, then the S&P, kind of middle of the road there, and NASDAQ was even below that. So NASDAQ is impacted even less than the S&P when it comes to better tax rates. So I thought that was very interesting. And actually, technology and materials are the two worst that will be impacted the least by a potential tax cut. Now, what else could help small caps? Number one is M&A, right? Small companies, they tend to be bought up. And so if M&A is less likely to happen, then there's less potential premium being built into a potential buyout. And so you're getting a little bit of a boost up there that the odds of the smaller companies being acquired has gone up a little bit. Okay. And so that's number one. Then regulations. Regulations often are a reason for small companies to be burdened, right? And the cost of that regulation often weighs heavier on those smaller companies because their compliance department, or whatever it is within their industry, to make sure that they're in compliance, it's spread amongst a lot less workers than those bigger names. Okay. And high exposure to industrials are expected to do well under the Trump administration. And a lot of those small cap indices have industrials along with energy, banks, and those are the industries that are likely to benefit from a Trump administration. And those are heavier concentration in the small cap indices as well. And then if you're looking at immigration and tariff policies, that might be net negative to the overall economy, but it could mean good things for a lot of domestic companies. So that's why you're seeing small caps do fairly well. It's a sector perspective as well as a regulatory perspective that the market is giving that boost to those smaller cap names. Now let's pivot back to the InvestTalk voice bank. It never closes. It's 888-9United-Chart.
Hi, Luke and Justin. Longtime listener here to the show from the Midwest. I'm looking to add some industrials to my portfolio. You guys have been talking about those for a while, and I believe there's still a good area to get into. Hopefully that's correct, and hopefully you still feel that'll be correct under the new presidential management coming up. I've been looking at just some funds. I believe they're both ETFs, that is VIS and XLI. I was wondering what you thought of those funds and their holdings and the dividends and everything. But then I heard Luke talking the other day about a good industry fund. I believe it was MLI. Do you feel it'd be better for me to get into one of these ETFs, or should I just go for the straight stock in the MLI? Thank you for your answers to my questions. Look forward to listening to you on the show. Have a great day.
All right, looking at the industrial space, we like the industrial space. Now, this got a Trump bump, but it's starting to fade a little bit. So we're waiting a little bit to, I think, be aggressive into this space, and still a lot to be figured out. I think the simple narrative that Trump is going to be good for equities is overly simplified. I think that it will be good for certain industries, and I think there'll be industries that he's going to be very bad for. And so I like that you're targeting an industry that or a part of the market that likely will benefit from a Trump administration. But that also doesn't mean it's going to straight line either. There's oftentimes good news and bad news that comes out with these priorities, and that's going to hit these sectors in rolling waves. Right now, the one that's getting hit the most is healthcare, especially pharma, because of RFK being the head of Health and Human Services. And so you see IYH, the healthcare ETF, that's at the lowest level since June. And so, there's probably going to be a period where that's priced in, and maybe the market's gone overboard, and maybe his aggressiveness isn't as hard as most people are pricing or are thinking. And same thing with industrials, right? Happening the other way. It's got the bump, but is it going to be as clear cut as otherwise? I don't think so. I don't think it's going to be as clear cut, and I think it's going to have some volatility. Now, when it comes to which one to buy, whether it's one of the ETFs or MLI, which is Mueller Industries, they make copper tube fitting for HVAC systems, refrigeration, plumbing markets, etc. And my issue with Mueller is always that, it got this big bump during COVID, made 90 cents a share in 2019, but made a 582 in 2022, 530 last year. So it's make 520 this year and 530 next year. So earnings have kind of plateaued here, and it's trading at $88 per share. So, are you going to pay a market multiple for a company that's pretty volatile from an earnings standpoint and cyclical? And then the chart is starting to, get a little tired. So I don't think Mueller would be my horse. I think there's better ones out there that have more history of earnings at this level. I think this could potentially be more of a flash in the pan type of COVID bump, and that's what worries me the most about Mueller. Still a good company, still good profitability, good balance sheet, et cetera. But I rather own right now just a broad-based ETF. I think that would kind of filter out a lot of the noise that's going to happen within this space. So I would go with a VIS or an XLI, something like that, over a Mueller. Okay. Now, from time to time, we also receive InvestTalk questions via email, and here's one that came in from Big G in North Carolina. It says, should I buy oil, gas, and hard assets? Got a lot of our IRA in cash, money market. I was thinking about gas pipeline producers, contractors, as natural gas is a clean energy source. What is your recommendation? Yeah, we love those businesses. We've owned one of them for a long period of time in many of our investment accounts or our strategies, and it got a big bump during post the election. One went from mid 90s all the way to about 110 at the close today. So it's had a nice move, and I think those will be more durable, especially because Trump's going to want to allow more drilling. Doesn't mean necessarily it's going to happen, but there will still continue to be gas flowing because we need to power our AI data centers and cloud data centers, et cetera. And obviously Trump is not against oil and gas. So I think that space is a good place to invest in for the long term. For more insights and resources, visit us at InvestTalk.com.
Hey, Justin and Luke, Marlo from New York. Love your show, longtime listener. Just have a question about a company, UGI. I'm trying to invest in energy, as you encourage. This is a gas company, and it's really focused in Pennsylvania. They have natural gas and propane and other things. It just seems like a good business. It's kind of recovered from the COVID high. So it's paying a healthy dividend, 6%. I know I'm not buying it just for that, but that's a nice yield. And I anticipate, over the next 5 years that it could continue to grow its business and have a good return. So just wanted to know what you thought about this, like a smaller regional play on a natural gas recovery over time. Love what you do. Thanks so much. I'll listen on the show.
I'm looking at UGI Corp, and its holding company. It has many businesses. One is transportation and marketing of energy and related services, mainly propane. And they also have a natural gas and electric distribution company, regulated utility. And so this is a name that, I like what you're thinking, but this is, I think, the wrong horse because if you look at their business, it's actually pretty poor. Revenues last quarter were down 17% year over year. Earnings last year were down 2% after being down 2% the year before. Earnings are only supposed to be up 4% this year. It is a smaller name, about $5 billion market cap. And then if I'm looking at the balance sheet, they have a lot of debt on their balance sheet. Good cash flow, $444 million. The problem is that, it's just too levered. Okay. And that dividend, I don't think is going to be sustainable. Maybe. I don't know. The chart is very neutral. It's just kind of gone sideways. Its profitability is return on invested capital is 5%, which is not horrible, but not great. Return on equity is around 15%. That's good. But, the The median is around 13% over the last 10 years. It's not bad. It's not bad. It's just, you said it can grow over the years. I don't see growth. I don't know where this is going to grow. I just think that if you're looking for natural gas, there's much better opportunities out there. Natural gas pipeline companies, for example. So propane distribution, I don't think it's really going to be. Is propane going to be used more under Trump for any particular reason? I don't see any justification for that. So, and it's a utility company as well, which is kind of a boring business. I just think you're looking at the wrong horse. You're in the right vicinity of the forest, right? But just barking up the wrong tree. I think you need to keep doing research and find better opportunities out there. Okay. Thanks for the call. Now let's touch on Jerome Powell's speech. And it was very interesting. It was yesterday. And he said the economy is not sending any signal that we need to be in a hurry to lower rates. So the strength we are currently seeing in the economy gives us the ability to approach our decision carefully. That's interesting, right? Where they've said that the risks in the economy are more balanced, but he's saying that there's good strength in the economy, which doesn't make a whole lot of sense. Now, the Fed's next meeting will be December 17th and 18th, so a week before Christmas. And that's when they'll make the decision on the potential final rate cut for the year. Like I said earlier, that would be 60% chance currently that they will cut in December. But now there's only 2 more cuts priced in for next year. Okay. I'm starting to think that they don't cut in December. The economic news has been fine. And I also think politically kind of makes more sense to wait. If you think about it, I'm not sure when the January meeting, let's see, when's the January meeting? January 29th. That'd be after the inauguration. I would imagine that he'd want, I just think of Trump, right? Trump would want to see, hey, you're cutting rates, you're trying to help me out to start my administration. I think you'd rather save that bullet for that January meeting. But what's most interesting about this as a whole, if I'm stepping back and, that's the minutia of this decision and the political environment, it's more of, hey, the Fed's actually getting less dovish. That's part of the reason rates have gone up. And part of the reason the dollar's gone up as well. So it's a very interesting shift here in policy. And I think it's becoming a lot more neutral than the market was expecting just a couple of months ago. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And remember, we can help you better understand your portfolio dynamics and calculate your risk number by heading over to investtalk.com, clicking on the portfolio review button. This is a free and confidential service. And if you haven't optimized the potential of your 401k, we can help there as well. And you can start again by heading over to investtalk.com. Independent thinking, shared success. It's InvestTalk. Enjoy your weekend.